So today we're going to talk about the Hunt brothers. And in the late 1970s, two Texas oil heirs pulled off a commodities play so outrageous that regulators literally had to rewrite the rulebook just to stop them. So, this story is about Nelson Bunker Hunt and William Herbert Hunt, and they attempted to corner the silver market, stockpiling over 200 million ounces and driving the price from around $2 an ounce in the early 1970s to nearly $50 an ounce by the 1980s. At the peak, their position was around $10 billion, and their buying frenzy rocked the whole global financial system. Just 2 years later, the Hunt brothers were bankrupt on trial for market manipulation after exchanges changed trading rules multiple times, forcing the brothers to unwind their positions in a complete fire sale. So, bit by bit, the true story behind this silver saga has emerged, and it has everything: bold strategies, loopholes, and a caged elephant on a plane, and even conflicted regulators who profited from the very changes that broke the Hunt brothers. At one point, the panic they caused brought the financial system within a hair's breadth of 1929 style crash. Literally, they broke the Western financial system. And by the last quarter, that's essentially what happened to the Hunt brothers. Now, fast forward to 2026. In a twist no one saw coming, a new silver crisis is unfolding right in front of our eyes, and one that echoes the Hunt brothers' trauma, but on a far larger scale than before. And instead of two billionaire brothers, the main player in 2026 is China and the mega banks, and they have effectively cornered the silver market by choking exports, and all silver prices are going through the roof, record highs, and Western banks that bet against that silver are getting decimated. Some are even whispering that silver could break into a triple digit, threatening the stability of major financial institutions. And history doesn't rhyme, but it sure does rhyme. To understand where we might be headed, we need to revisit the Hunt brothers' wild ride and then see how today's events are strikingly and frighteningly similar to the Hunt brothers' silver ambitions. So, these insane series of events revolve around the Hunt brothers family. So basically, H.L. Hunt had built one of America's biggest oil fortunes by the mid 20th century. He instilled in his children a deep distrust of paper money. The Hunts were hard money true believers, the kind of people who felt US dollars would be debased by inflation and that tangible assets were the only safe way to preserve wealth. Bunker and Herbert Hunt, two of H.L.'s 15 children, worked side by side and expanded the family's empire and their investments. So by late 1960s and early 70s, they were already extraordinarily wealthy, one of the wealthiest in the United States of America. But they feared that the government's monetary policies were eroding the value of their dollar. Just like the Roman Empire, where the Roman king started chipping off the silver coins, the Hunt brothers thought that this was what was unwinding in the 20th century. So the turning point came in 1971, really, when President Nixon took off US from the gold standard, severing the dollar's convertibility to gold. And that's a story that we all know. To the Hunts, this was like a sign of the apocalypse. And they believed that the dollar would become nothing more than monopoly money. Fugazi, fugazi. As bankers later put it, just about anything you buy rather than paper is better. If you don't like gold, use silver or diamonds or copper. But something. Any damn fool can run a printing press. In other words, they say precious metals are the ultimate hedge against inflation and currency debasement. Initially, Bunker Hunt started diversifying into hard assets quietly. He bought millions of acres of Australian ranch and even invested in thoroughbred racehorses. One of his horses became the first female horse to earn $1 million in winnings. The supply of silver was relatively tight comparing it to gold. The US government had stopped circulating silver coins and had even outlawed private ownership of gold bullion until the 1975. The Hunt brothers began accumulating silver in the early 70s when it was dirt cheap, around like $1.50 or even $2 per ounce. But by 1973, inflation was picking up and silver had inched about $2 an ounce. They started buying in great sizes. At first, they simply bought physical silver and stashed it in overseas vaults. But their ambitions slowly started growing, so did their greed. They turned to the New York Commodities Exchange, COMEX, to leverage their purchases. They started using silver future contracts and agreements to buy a certain amount of silver at a future date as a way to gain control of large quantities of silver without immediately having to store it all. The Hunt brothers fully intended to take delivery of their metal. So by 1974, the Hunts amassed future contracts for an astounding 35 million ounces of silver and took delivery on all of it. So instead of closing out the contracts for a profit, they literally had tens of millions of ounces of bullion delivered to them. This helped drive silver from about $3 to $6 an ounce in the process. The markets were starting to realize that something big was happening. Someone was wobbling up silver like never frickin' before. And the Hunt brothers' aggressive buying set off alarm bells for traders on the other side. For those future contracts, and even a famous commodity dealer, Dr. Henry Cherokee of Motueka Metals, had taken the opposite side. He had sold his silver shorts via futures, meaning he'd agreed to deliver silver at a fixed price in the future. But as silver prices soared, Cherokee faced a huge problem. He didn't have enough physical silver to honor these contracts. If Hunts demanded delivery, he'd be caught in a squeeze, forcing to buy silver at skyrocketing prices to deliver them to the Hunt brothers. And the Hunt brothers knew this very well, and they triggered the noose. They kept signaling that they would indeed demand the metal, and desperate to avoid ruin, Cherokee scrambled for a savior and found an unlikely place that was the Bank of Mexico. So, what does Mexico's central bank do? They happen to hold a large stockpile, maybe around 50 million ounces, and they bought that under $2, all of it. So Cherokee flew to Mexico City and convinced the Mexican officials to dump their silver immediately, arguing that the current $6 price was an artificial high and they'd never get a better freaking deal, and that temporarily foiled the Hunt brothers, and the Bank of Mexico sold its 50 million ounces into the market. Suddenly, the flood of supply caused the silver to tumble back from $6 to $4 an ounce almost overnight. So, silver was acting like a meme stock back in the days, back in the 70s. And that annoyed the Hunt brothers, but they were undeterred. By now, they had around 55 million ounces of silver. That was roughly 10% of the entire world's annual silver production. However, they grew fearful that the US government might interfere more directly, perhaps even ban private silver ownership, as it did with gold in the 1930s. So, the Hunts took an unusual precaution. They started shipping this silver overseas. Through 1974, ton after ton, the Hunt's silver was loaded into planes bounded for underground vaults in Switzerland. Here's where one of the wildest anecdotes of the saga comes in. The Hunt brothers chartered a large jet, Boeing 707, to ferry the silver bars across the Atlantic to Swiss vaults. On one such flight, they loaded up 1 million ounces of silver bars. To balance the weight of the cargo, they stacked the bars along the side, leaving an open space in the middle. Since they had extra room and apparently a sense of humor, they agreed also to transport a live elephant that needed a lift to Europe. So that is crazy that the Hunt brothers transported this elephant, and the elephant was secured in a crate in the hold, surrounded by walls of silver. Partway through the flight, as the story goes, the plane suddenly lurched into a dive and then began going nose up, then plunging back downwards. Panicked, one of the Hunts, maybe Lamar Hunt, who was accompanying the cargo, rushed to the hold. He found that the elephant was actually rocking its crate and swinging its trunk and had managed to snag some control cables for the tail flaps. And in a moment of straight out of the movie, Lamar grabbed the first thing he could find, a rubber tire, which was apparently in a plane, and hurled it at the elephant into letting go of the cables. And it worked. The elephant backed off and the pilots regained control. It was a disaster that could have gone, very bad. Airlifting bullions and zoo animals aside, the Hunt brothers in the mid 80s had become the dominant force in silver. With tens of millions of ounces tucked away in Swiss vaults, the prices of silver climbed down for a few years, hovering roughly $4 to $5 average. The Hunts actually paused their silver accumulation in 1975 and 1976. Partly because owning that much silver metal was costly to store and insure, and partly because they were beginning to attract regulatory sanctions. For a while, the silver market went quiet, but the Hunt brothers were simply catching their breath. Their most audacious move was still to come. Before unleashing their endgame in silver, the Hunt brothers tried their hands at dominating another commodity, soya beans. In 1977, the brothers waded into the soybean futures market, perhaps to see if they could use similar tactics outside of the metals, and that thing made them a fortune. By the late 1977, the Hunts, through various accounts, controlled over 20 million Brussels of soybean futures, more than 1/3 of the entire US soybean crop due to harvest that year. This brazen position exceeded the exchange position limit, which was about 3 million Brussels, by a huge freaking margin. But unsurprisingly, it drove up soybean prices and raised the IRE of the regulators. The Commodity Future Trading Commission (CFTC) stepped in and sued the Hunts, forcing them to liquidate most of their soybean stake. The brothers also paid a fine of around $500,000 for violating trading limits. It was a slap on the wrist, but it signaled that authorities were watching the Hunt brothers real close. The Hunts, after the soybean trade, renewed their focus on silver in 1978. This time, they refined their strategy and bought in reinforcements. Instead of simply buying and taking delivery themselves, they began operating through a tangled web of entities and allies, including business associates and family members of the Saudi royal family. By spreading their purchases across multiple accounts and partners, the Hunt brothers hoped to obscure the true size of their position and perhaps dodge the regulators' positions limits. They also shifted tactics in the future markets because these Hunt brothers were like really intelligent, and rather than taking delivery on every contract, the Hunts started rolling over future contracts to build an even growing position without immediately piling up more physical silver than that they could handle. For example, if they held a contract to buy 500,000 ounces in March, as the delivery date approached, they would sell that March contract, avoiding taking delivery that month, and simultaneously buying a new contract for April or May. This way, they maintained a large portion in silver futures but delayed taking delivery until a chosen time. And it was way to keep leverage control of a huge amount of silver on paper, obviously, while waiting for the right moment to demand the actual metals. So in the mid 1979, Bunker and Herbert Hunt, along with two Saudi businessmen, royal family, formed a new entity in Bermuda called the International Metal Investment, effectively a silver buying front through IMIC and dozens of other accounts. They went on an epic buying spree. So by the fall of 1979, Hunt and their allies controlled an estimate of 200 million ounces of silver between silver bullion and futures contracts. Nearly half of the world's annual mine production. This was abso-freaking-lutely unprecedented. In other words, they were going for the kill shot, a delivery squeeze that could potentially break the whole Western financial market. And silver rocketed to $50 an ounce. The bankers had to step in because, the bankers, if you and me, we make a trade and we lose on it, no one in the world would care. But when the big bankers lose a trade, the government steps in to save them every time. And that's been happening from the 70s. So, as news spread that a few wealthy players controlled so much silver, panic gripped the exchanges. The prices of silver, which had been like $8 in the early 1979, doubled to $16 by the fall of 1979. And by January 1980, it doubled again, blowing past $30, then $40, then briefly touching $50.35 an ounce on the COMEX. The Hunt's gambit was working. Silver was in a feeding frenzy. Families were digging through attics for old silver coins, tea sets to sell for scrap. Newspapers ran the story about ordinary people cashing in their heirlooms to profit from a boom. A single silver teaspoon that had been worth like $1 was suddenly worth over $30 freaking. And silver was on every nightly newscast and the Hunt brothers were the talk of the world market. At its peak in January 1980, the Hunt brothers estimated to hold one third of non government silver on Earth. The two private citizens effectively cornered a global commodity. Tiffany and Co., the famous jewelers that you know, even took out a full page plea in the New York Times begging the Hunt brothers to stop their madness, accusing the Hunt brothers of hoarding silver so high that others must pay artificial high prices. Behind the scenes, the situation was really dire for those who had sold silver shorts. The two main precious metal exchanges, COMEX, the New York, and the CBOT in Chicago, together had only about 120 million ounces of silver in their warehouses. That might sound like a freaking lot, but the Hunts and their partners were in line to demand much more than that for delivery. A delivery default loomed at the exchanges, and the exchanges could literally run out of silver to deliver to the Hunt brothers, which would be so catastrophic and it would be so shameful and humiliating for these big bankers. And it would be the failure of the modern Western economic system. So the exchanges and their regulators scrambled to act. They saw the Hunt brothers' position as an existential threat to the market and perhaps to the whole freaking economy. So, first, in late 1979, the Chicago Board of Traders imposed a position limit and forced liquidations on their exchanges. Isn't that like really criminal? And they were capping any one trader to 3 million ounces, compelling anyone over that to sell. And the Hunt brothers had been using CBOT in addition to COMEX, so this move was aimed squarely at them. Bunker Hunt was extremely angry. He was in a bad mood and he publicly accused the exchange board of changing the rules mid game to save their own skin. And he wasn't entirely wrong, let's just say. But privately, they realized this was a serious blow. Still, they tried to cooperate just enough to keep exchanges from outright defaults. Herbert Hunt attended a COMEX meeting and agreed to hold off demanding delivery on some contracts, effectively giving the exchange a bit of breathing room. In exchange for a delay on their massive margin payments that would have been due from the new rules, for a brief moment, the Hunts seemed to have negotiated a truce. But 2 weeks later, the situation reached a breaking point. And indeed, those rules likely saved many of the exchange insiders. By some reports, 9 COMEX board members collectively held 7,700 short contracts over 38 million ounces and stood to gain nearly 2 billion from the silver's decline. The conflict of interest was glaring, and the Hunts cried foul to anyone who would listen. But unfortunately, there was no one left to listen. Years later, these actions and relationships would be scrutinized, but in the crisis of the moment, survival of the system took precedence over fairness. Though the Hunt brothers had been dealt a heavy blow by the rule changes, they still held an enormous amount of silver and debts to match. Remember, a lot of their purchases were leveraged. They had borrowed hundreds of millions of dollars against their possessions, and as prices dropped, margin calls started coming fast and furious. The Hunts needed to put up more cash or collateral to cover the declining value of futures. Initially, they doubled down Through January and February 1980, the brothers borrowed over $1 billion from the banks and the brokers to meet their margin calls and kept their silver stash afloat. They even used their massive holdings of other assets like oil company shares as collateral. But with the prices in free fall, it was like trying to hold back a collapsing dam. By late March 1980, silver had plunged to as low as $10, an 80% collapse from the peak. The hunts were decimated. 27th March 1980 became known as the Silver Thursday. That day, hunts could not meet $100 million margin call and they defaulted. Their brokers liquidated what remained of Hunt's future positions, dumping silver contracts into the market, which sent the price crashing even below $10. The sudden crash reverberated far beyond the Hunt's portfolio. It threatened to topple the brokerage and potentially other financial institutions linked to silver. There was genuinely fear that if the Hunts went without paying their debts, major Wall Street firms and banks might collapse too. To stave off broader crisis, a group of US banks, with a nudge from the Federal Reserve, quickly assembled a $1.1 billion emergency line of credit to the Hunts. This loan effectively bailed out the brokers and kept the financial dominoes from falling, but it was secured by nearly all of the Hunt's remaining assets. The Hunt brothers, once worth billions, were financially in ruins. They eventually had to declare bankruptcy in 1988, one of the largest personal bankruptcies in US history. After years of litigation and asset seizures, in the aftermath, the CFTC and the SEC launched investigations into the Hunt's activities, and in 1985, regulators officially concluded that the Hunts had indeed manipulated the silver market by cornering it and driving up the price artificially. The brothers argued that they were protecting themselves from inflation and that the real cheaters were the exchanges that changed the rules. However, a stack of lawsuits from angry investors and businesses hurt by the silver spike said otherwise. So in 1988, in a civil trial, Bunker and Herbert Hunt were found liable for conspiring to corner the market, and they were ordered to pay a hefty $1 billion in damages. At that point, the brothers were over $1 billion in debt and had to sell off everything: ranches, oil fields, coin collections, you name it, to settle their debts. Thus ended the Hunt brothers' wild silver saga. But it remains one of the most dramatic episodes in financial history. A true tale of boom to bust. Were the Hunts greedy villains who broke the market for their personal gain? Or were there visionaries who exposed how the system is rigged against outsiders? The answer might be a bit of both. Certainly, they tried to change the system to their advantage, which is, in sorts, illegal. But it's also true that establishment moved their goalposts to take them down. And insiders profited from that same crash. The 1980s silver corner became a textbook case that changed commodities regulations, position limits, enhanced oversight to prevent any single player from doing that again, or so we thought. Little did we know, over 40 years later, the silver market would once again be the front of news pages. Not because of Texas billionaires, but due to global power plays and a modern short squeeze that has potential to dwarf the Hunt episode. It's now 2026, and incredibly, silver is at the center of a new worldwide drama. The Hunt brothers might be long gone from the market, but the ingredients of a squeeze, supply, heavy leverage, and a dash of geopolitical tension are all back again. The role of market cornering this time isn't a rogue trader, it's a giant country, China. The world's factory, a dominant force in raw materials. So, on January 1st, 2026, China implemented a bombshell policy. It sharply restricted exports of refined silver, reclassifying silver as a strategic commodity under their state control. So, Beijing announced that for the next 2 years, only 44 government approved companies, most large smelters and state run firms, would be allowed to export silver. Any other refinery or producer in China is effectively barred from selling silver abroad. This move has invoked comparisons to China's past use of export controls on rare earth metals, critical materials for high-tech industries that China famously used as economic leverage. So China is weaponizing silver in 2026. Why in the hell would China corner the silver market? Well, it has several reasons. First, China needs silver at home. It's the world's largest industrial consumer of silver, and thanks to enormous electronics, solar panels, and electric vehicle industries. Silver is crucial for solar panels, which use silver in photovoltaic cells, and China leads the solar energy expansion. Silver is also used in EV batteries, 5G networks, semiconductors, and you can name it, there's some silver in it. All areas which China views as strategic. So, by curbing exports, China aims to secure its domestic supply for these priority sectors. It's essentially stockpiling the raw material needed for its clean energy and tech ambitions. Secondly, it's a geopolitical chess move. In the late 2025, the United States added silver to its list of critical minerals that hinted at a possible trade measure to secure silver supply. Sensing that China preemptively tightened its grip, controlling critical metals used in every form of missile, every form of smartphone, to make their nations dependent. By treating silver in the same way as rare earths, Beijing is sending a clear message to the Western nations. And they're saying we can choke off key resources in return. And China could choke the whole world's global supply chain. Thirdly, the market context favored such a move. China's silver stockpiles were reportedly dwindling after years of record high exports from 2024 to 2025. Indeed, China had exported a whopping 3.8 billion worth of silver in 2024 amid surging global demands. This drew down inventories, but late 2025, the global silver market was already structurally in a deficit. For the fifth straight year, demand outstripped mining supply. So the Chinese authorities likely saw that uncontrolled exports were shipping away a resource they might soon lack. So they acted to hoard what's left of the domestic use. The immediate impact of China's announcement was shock and chaos in the silver market. In December 2025, rumors of the export ban started circulating. Many Chinese smelters halted silver deliveries abroad in anticipation. Buyers around the world scrambled to secure physical silver before the gates closed. Premiums on coins and bars have shot up to like a ridiculous number. Some say over $100 an ounce. By the end of 2025, silver prices had already been on a tear. Spot silver all-time high, trading above 83 to 84 ounces, and in late December, finally surpassing what was known to be uncharted territory for silver. And once the export controls kicked in January 1st, 2026, the rally has only accelerated. Faster and faster, down goes the ship. Within days, wholesale silver buyers reported that physical metal was extremely scarce. Mints and refiners in North America and Europe found it harder to get raw silver. Industry users like electronics manufacturers, solar panel producers grew alarmed at the prospect of silver shortfalls, so physical silver began decoupling from the paper price on the future exchanges. For example, around the first week of January, the highly traded COMEX silver futures contract for March 2026 was priced about $72 an ounce. Yet, in Dubai's bullion market, a 1 ounce silver coin was selling for nearly $100 an ounce. Yeah, you guessed that right. That's like not a small gap, not a middle sized gap, it's like a huge gap, and reflects that real metals in custody are more important than any future exchanges. Even Elon Musk, the greatest entrepreneur of our times, and perhaps the most famous industrialist, chimed in on the situation as silver blew past $80. Musk tweeted a stark warning: this is not good. Silver is needed in many processes. His companies, from Tesla's EVs to SpaceX Starlink satellites, rely on silver. So, supply crunch and soaring prices directly threaten their production cost. If anyone thought the silver squeeze was just a speculation game, manufacturers like Musk set them straight. This was a real world supply crisis. Silver's strategic importance was underscored by government actions as well. In Europe, electronics and solar firms have started exploring substitution materials like copper for electrical contacts, despite performance trade-offs, a sign of how desperate the Europeans and the Americans are getting. And with China effectively removing potentially hundreds of millions of ounces from the global supply pipeline, China's historically refined and exported 70% of the world's silver. Prices can go vertical, and by mid-January 2026, silver blew past its December high. On the morning of January 15th, it hit $92 per ounce in the international markets. An astonishing figure, no more, double the price just a few months prior. And that's marked another record. Silver became more expensive than oil an ounce per ounce basis. If the Hunt brothers were still around, or if the Hunt brothers came out of their coffins, they might have cracked a smile seeing all of this, because the circumstances were different, but the results are somewhat familiar. A feeding frenzy and a short squeeze. So, the greatest short squeeze ever was when the banks got caught in the storm. In 1980, the villains, depending on who you asked, were the Hunt brothers. But in 2026, to some silver bulls, the villains are the Western bullion banks and traders who had shorted silver for years and now are getting caught in the vice. For a long time, big banks have made money shorting or suppressing silver prices. Indeed, several were fined in 2010s for manipulating the silver market. They could do this in part because paper silver market is huge compared to the actual silver available. As of early 2026, there were about 350 ounces to paper silver claims for every 1 ounce of real silver in the vaults. That's more than 360 to 1 ratio, and it is just giving me a headache. Such leverage works until people start demanding the real thing. And with China's squeeze and the investors running for their lives, that moment has finally arrived. The Hunt brothers of 2026 aren't individuals at all. They're China, the global solar industry, and even some central banks. And these players are all hoovering up physical silver, leaving the short selling banks in a dangerous spot. In 1980s, the big difference is that the scale is not local, it's now global. London and New York, the traditional hubs of paper precious metal trading, the LBMA and the COMEX, are seeing an exodus of physical silver. One market strategist noted that the Western vaults, like those in London, hold only about 22,000 tons of silver in total, and that silver is being rapidly claimed or moved to places like Shanghai or Dubai for higher prices. The pressures on the shorts began showing dramatically in January 2026. One high-profile example is TD Securities, a major Canadian bank trading arm, and they decided to bet that the silver's run-up was overdone. In early January, TD announced a short position around $78 an ounce, with a target that silver would drop to $40. But this contrarian call went badly wrong. As silver kept rising, TD's position was in jeopardy by January 14th as silver hovered around $78 to $80 an ounce. Reports emerged that TD's stop-loss orders were triggered, effectively stopping out their short positions for a sizable loss. In fact, within weeks of their trade, silver had surged well above the pain threshold, forcing them to eat a loss. For TD and others who bet on the crash, it was a humbling lesson. Don't try to catch a falling knife, and in this case, a rocket-propelled silver market. But that was small potatoes compared to the bombshell that dropped on 15th January. On that day, a leaked international report from UBS, Switzerland's largest bank, sent shockwaves through the financial world. The report, marked urgent, confidential, revealed that silver market watchers had long suspected UBS was sitting on an absolute massive short silver position, largely inherited from its takeover of Credit Suisse back in 2023. How massive, you ask? Roughly 5.2 billion troy ounces net short, an amount over 8 times the entire world's annual silver mine production. To put it in perspective, that's like being short all the silver mined globally for the next 8 years. It was a mind-boggling figure, and if accurate, it meant UBS and its extension, the Swiss banking system, was and is in deep trouble. The UBS risk report allegedly painted a doomsday scenario. The Swiss National Bank, SNB, Switzerland's central bank, had reportedly issued an ultimatum to UBS to cut 80% of its silver shorts by February 10, 2026. Essentially, UBS would have to buy back over 4 billion ounces of silver in 30 days to cover their mandate. That number is so astronomical as to be impossible. On a typical day, only 8 million ounces of silver trades on major commodity exchanges. And UBS is trying to buy 4,000 million ounces in a month would be like trying to drain an ocean with a coffee mug. The leaked report authors plainly stated that such an event would be so catastrophic. Their models have projected that the silver price would spike to $300 an ounce. And that's just a base case. And potentially a $400+ in a panic. It predicts a financial suicide for the bank's losses, which are over $100 billion for only UBS. And that could effectively wipe out the whole of the modern financial system. Not only that, but it warned a wider fallout. A spike to $300 plus silver would inflict huge losses on other banks, trigger a wealth transfer of nearly $700 billion to nations holding lots of silver. Specifically mentioned, the BRICS countries will be benefiting heavily. It's even speculated that physical silver could become so scarce that large bars would command premiums, pushing their prices upward of $400 an ounce. In short, the report depicts a scenario where UBS short position could implode the Swiss financial center and send the Swiss franc into a crisis mode. No wonder it was marked urgent. It reads like a financial thriller horror movie scene, except it was supposed to be an internal document from a major bank. Whether entirely factual or not, the mere possibility that a Goliath bank could be caught in a short that badly lit a fire under the market, silver bugs gleefully dubbed it the biggest short squeeze in history. After all, if the hunts nearly blew up Wall Street by cornering 200 million ounces of silver, what would happen if 5.2 billion ounces needed to be bought back? The mind simply reels. One thing was clear: confidence in the paper silver market has absolutely shattered. And around the same time, an industrial comment noted that the paper to physical ratio has ballooned to 356 to 1, an inordinate amount of paper promises for every physical ounce. As one strategist said, holders of silver ETFs and futures began demanding delivery or redemption in metals, not trusting the system. COMEX in New York and the LBMA in London suddenly found themselves in a precarious spot. These institutions for years have operated under the assumption that most trade is settled in cash and there's no demand for physical delivery. But now that assumption was cracked. By early 2026, London silver investors were drawn down historic lows. The COMEX vaults were shrinking fast. The situation was so extreme that some market watchers warned that COMEX or LBMA could actually break, defaulting on delivery obligations. And if that happens, it would be once in a century shock for the financial system. This was a broad rush by states, industries, and countless investors worldwide. The genie is finally coming out of the bottle, and a new era for silver has started. Standing here in January 2026, the silver market is at a crossroad not seen since the Hunt's time. They argue that the prices could go even higher if a full blown short squeeze or monetary crisis unfolds. On the other hand, history also teaches caution. Parabolic moves can crash just as hard. Governments have tools like they have strategic reserves and emergency regulations that they could deploy to tame a runaway market. Indeed, these are the rumors of diplomatic talks. What seems undeniable is the world's approach to silver and the resource in general. We are seeing a more divided world, East versus West, paper versus physical. The West, now for years, is accustomed to low commodity prices and abundant supply via global markets. But now they're suddenly being confronted with the vulnerability of that system. The long standing dominance of London and New York in setting the prices is being challenged by the Shanghai and Dubai, where physical buying is the king. If the COMEX or the LBMA were effectively run dry or default, it could deal a blow to the Western financial credibility. The Hunt brothers believed in sound money and bet on silver, but they were arguably way ahead of their time, and they were defeated by the US establishment's power. But today's currency is debased, and money printing has gone insane. And now foreign actors, nations, are leveraging silver to gain an upper hand, which could in turn expose the weakness of Western banking that heavily shorted precious metals. So, history is being made in the silver market as we speak. The situation is fluid and it could take months or years to fully play out. One plausible outcome is a new equilibrium where silver trades at a much higher price, reflecting the true supply-demand tightness. Hunt brothers, in their quest, preached that the dollar would weaken and hard money would rule the day. They were dismissed as crazy billionaire cowboys at the time, but decades later, their core thesis on the currency debasement has largely played out, and currencies have lost their value to gold and silver. The Hunt's error was not what they believed, but how they acted. In a way, they were too early, too aggressive, and they paid the price. Today's silver squeeze shows that they weren't wholly wrong about the endgame. They were just generations ahead. Some say Hunt brothers didn't even corner the silver market. It was the geopolitical uncertainty around that time. Maybe the Hunt brothers moved the price of silver $1 or $2 at max, but the rest of it was something beyond the Hunt brothers' control. But they were made the scapegoat by the US regulatories and authorities. And whenever we hear about the 1980s silver short squeeze, we always say, oh, it was the Hunt brothers that were responsible for the short squeeze. But actually, it is the debasement of currencies. It is the loss of your purchasing power. And this is real this time. The story of the Hunt brothers is a cautionary tale of market greed. It's a saga of sound money, ideals colliding with financial realities. And now, with the world in the midst of a new silver crisis, it has the ghost of Bunker and Herbert Hunt loom over the market, whispering, "We told you so." Once again, we see that when trust falters, whether in paper money or paper silver, people rush to anything that they can grab. Silver, the shiny metal that bridged the Hunt's empire and today's tech economy, has become a battleground between the East and the West, between the physical holders and the paper shorters. No one can predict exactly how this will end, but maybe cooler heads will prevail and stability will return. Or maybe we're on the brink of a seismic shift, a monetary earthquake where silver value resets much higher and the old financial guardians like the COMEX, the LBMA, and the big banks get upended. As investors and citizens, it's riveting drama to witness, with stakes that go beyond profits, and changing the rules might not be so simple this time. One thing is for certain: the lesson of the Hunt brothers resonates louder than ever. Sound money, whether it be silver or gold, remains a refuge in times of uncertainty, and excessive leverage or manipulation, be it by private traders or institutions, can lead to spectacular downfalls. The Hunts may have been a little too ahead of their time, but their saga wasn't in vain. It foreshadowed the very dynamics we're watching unfold now, as the world grapples with what could be the greatest short squeeze and resources power play in history. It's worth remembering the famous quote, "History doesn't repeat, but it often rhymes." In the rhyme of the Hans and the 2026 silver squeeze, we hear echoes of the past, warnings for the present, and certainly for the future.